Hello and welcome to Fireside with VC. My name is Andrew Romans and I'm very excited to have Karen McCormick on the podcast. Karen is the Chief Investment Officer and has been with Beringea since I think I met you, Karen, shortly after you started about 14 years ago. Great to see you and thanks for
Yeah,
coming on the
that's right.
podcast.
It's such a pleasure. It's great to see you too.
So I believe, you guys have grown bounds and bounds over these last 14 years, but I believe you guys are now you're based in London, other key offices in Michigan. Is that right? And it's about 700 million of AUM. Is
Okay.
that about right?
Yep, that's right. Yeah, I think about 750 now. But yeah, in rough terms, across the two offices. So it's relatively evenly split across London and the US.
Okay. And Karen, tell me about the genesis of Beringea. Obviously, there's a Michigan connection. Maybe tell us the historical story
Yeah.
before getting to where you guys are today.
Yep. So I'm going to get this directionally correct and specifically wrong. And Malcolm and Charlie, the two founders of Beringea, would tell the story better than I would. But so Beringea has been around for more than 30 years now. It grew up as two separate entities. So the US actually started out as more of a corporate finance house going back some 30 odd years. One of the founders was based in Michigan, or actually two of the founders at the time were based in Michigan, and they did quite a lot of work in automotive engineering and healthcare. And that makes sense in Michigan because in the US, it's the home of kind of automotive, which spins itself out into a whole lot of different engineering areas. And then it's also a real hub for healthcare, in part because there's a lot of teaching hospitals there. And from that springs out a lot of medical device type companies and a lot of healthcare related companies. So the US business was originally a corporate finance business with a focus on Michigan related types of investments. UK entity actually started out as the Guinness Man Funds, which was in part Guinness family backed money. That management team eventually sold off the funds, spun themselves out, and started Beringea and started raising funds independently, going back now in the latest 90s. So Beringea UK has been around for more or less since 99, 2000-ish, so 20 some odd years. The original funds that Beringea was managing, probably even earlier than that actually, were investing some of the money in the US, and there was a specific bent on healthcare and media. So there was a healthcare fund that Beringea was originally running and a media fund that they were running backed by strategics in the industry. So Malcolm, the UK founder, went to the US, met this small corporate finance boutique who happened to be specializing in healthcare and by then had also developed an expertise in media and opened an LA office. And did a bunch of deals with them, got on really well, and they merged businesses. And this is back in, again, like the early 2000s, maybe even earlier than that. So since, for about 20 some odd years, we've had both companies merged. There is no specific headquarters. The US business transitioned pretty quickly from being corporate finance into really just being a venture capital house, investing funds from the US. Back in, I think it was 2007, so shortly after I joined, and when I had very little say in how the company ran because I was junior and new, the business decided to consolidate the US offices. And initially, my assumption was that means we consolidate into LA because California was such a hub for venture. But Beringea decided to consolidate into Michigan. And a very good question at the time felt like, why? But it turned out to be an incredibly good decision because if you think back to 2007, it was followed by 2008 and 2009 when the market in the US just completely tanked. And Michigan and Detroit became the poster child for downtrodden America. The Obama administration at the time and most of the US really just did not want to see Detroit fail because it was, such a deep and rich history for the US. And there were quite a lot of incentives that were pumped into the Detroit area and greater Michigan. There weren't that many houses around to invest it. And so our funds under management grew rapidly, but we also were able to help lots of companies commercialize into Michigan, help them with things like how do you take advantage of certain tax grants, relatively cheap location, great access to talent that was far more affordable, great tax regimes. And so we were able to not only invest in a lot of companies that were Midwest based, but move a lot of companies into Michigan where they thrived based on the ecosystem that was there, basically. So now we have the two different offices. We invest pan US, but we do have a penchant for the Midwest in the US. And then the London office invests really pan-Europe. And we have, because of the transatlantic nature, we really do have a specialty in helping companies commercialize more often from Europe to the US, because every founder wants to go to the US, but then also from the US to Europe.
Okay. And was there some government money from Michigan that required a certain percentage of your portfolio companies to be domiciled or have operations in Michigan?
Not that I'm aware of. I mean, certainly. So one of our limited partners definitely has a penchant for companies that are Midwest based or are in Michigan, but I don't believe, I'd have to double check. I don't believe we have any contractual agreements to have to invest
Okay.
money specifically in Michigan.
Okay, that's cool. And generally, what's the composition of the LPs without naming names? We're talking family
Yeah,
offices
sure.
or any of like, I don't know, Ford Motor Company or any of these guys actually strategic LPs as well?
Yeah, interesting. So Ford used to be quite a long time ago, but when we moved away from some of the more automotive engineering type stuff, at the moment we basically just have, in the U.S. we have pretty traditional institutional LPs, and they've been incredibly supportive and continue to reinvest in the funds, which is great. Most of the funds in the U.S. are structured as traditional 10-year sort of LP GP structures, but because we have a really supportive and wonderful investor and we've generated great returns for them, they tend to keep reinvesting. The UK is evergreen because we're listed funds. So we
Oh,
don't go
right.
out and re-raise the funds every 3 to 5 years. Yeah. We're in the UK, we are a tax advantaged vehicle called Venture Capital Trust Funds.
A
So we're
VCT, yeah.
listed on AIM. Our investors get a tax break for, our investors get a tax break for investing in the funds. And then there are certain regulations that we have to comply with. Like there are certain industries we can't invest in. We couldn't invest in effectively a bank that's investing in other things. We can't invest in stuff like shipbuilding, but there are restrictions around what we can invest in. And there's definitely a bent towards making sure a decent chunk of our money goes towards development in the UK.
Right. You know, it's interesting because I've often thought that this 2 and 20 model with a 6-year commitment period, which is really a 2.5, 3-year commitment period, and winding up after even 12 years or even extending to year 14 with limited partner consent is maybe not the best fit in the world for the startups or the end LPs. You know, I mean, if the VC is motivated to have an exit or even sell something on the secondary market for a partial exit to put points on the board ahead of their next LP fundraising to show distributions of DPI, not just
Yeah.
TVPI, that may not be what, like, if there's a very wealthy sovereign wealth fund or high net worth individual or family office, whoever the LP is, they might say, hey, it's a little early to be selling Apple Computer, or it's a little early to be selling this Amazon stock just because you survived a lockup on, the
Yeah.
IPO.
It does give us a lot of flexibility. So I get the idea that investors want to return at some point and not just to hold shares in perpetuity. And we don't have, the private market doesn't have the liquidity of the public market. And so they want some assurance that there's going to be an opportunity for them to realize. I do understand that. The structure that we have works for us because we pay out dividends and we do share buybacks. Our rate of redemption is less than 1% every year. So we have shareholders who tend to hold for the long term and make most of their money back through dividend payouts. And we do tend to pay, on large realizations, we tend to pay out in addition to trying to generate a 5% annual dividend. But it works well for us in having the permanent capital because we can make those kinds of decisions. So while we do look to sell companies, we want a return as well and we want a realization. We can be a lot more flexible depending on the type of company, the time that we invested, when we think is a good time to sell. I think one of the longest running companies in the portfolio we held for almost 17 years, and that was intentional because it turned out to be just a great yielder. It was a company that ended up with a dominant market position in the UK. It was never going to be a unicorn, nor was that our investment thesis. And we had opportunities to sell, but in reality, it was very cash generative, paid great dividends. And so we just held it for quite a long time. And ultimately, when the founders decided had done it for long enough and they wanted to sell, we supported them because fair enough, they had been doing it forever, but we would have loved to just, maintain that one. So it does allow for flexibility.
It reminds me of Pitch Johnson, who's like 94 years old now, who like describes how he was in Boolean software for 30 years and Amgen, he's still in it. Like, he just never sells because it's his money, largely that in
Yep.
Stanford, I think. But yeah, I think it makes sense that one day more VC funds would be publicly traded or listed so that the LPs can get liquid at whatever the market is offering, and the fund still has the capital. It's just trading from one LP, to another. So you don't have like a hedge fund getting redeemed and, drawn down, like run on the bank to zero. So you have your portfolio construction that works, and you can take more of a permanent approach. How does carried interest work? And how does 2 and 20? How does management fee, or is this
Oh
not to
my
be
God,
disclosed?
it's too much of a nightmare for me to get into. I mean,
Okay.
that is one of the challenges with having permanent capital and listed funds, because you think about what happens when you get in the carry, and this did actually happen to us. And again, I'm going to get this specifically wrong, but directionally correct. So we were one of the first VCTs to get into the carry, and I don't remember what the hurdle rate was, but we had a hurdle rate. So we hit the hurdle rate. We returned a good amount of money to the investors. The challenge was then, okay, does that mean once you've hit the hurdle, if it's permanent capital and we keep re-upping every year and adding to the pot, are we just in the carry in perpetuity? Like, are we going to be earning carry basically on new money coming in? Because if you think about a traditional structure, once you're in the carry, you're taking 20% of the realizations. In a 2 and 20 structure, it doesn't make sense for us to continue to taking 20% of every realization, when for some of the investors, they're in effectively a new fund, because our fund never ends. We don't wind it up and then start a new fund and then have to meet the carry again there. So that led to us kind of having to restructure the carry a couple of times. I think it works reasonably well now. I wouldn't say we wouldn't have to restructure it again, because like we're learning as we go. We must be, I mean, the VCT industry must be one of the first areas where venture capital investing became a listed business or a listed opportunity. And so we're learning as we go with a lot of these things. But I think we have a good structure now. The US, I can't remember offhand, but it's a pretty traditional structure in terms of hurdle rates, management fees, and carried interest. I mean, to your earlier point, though, about the kind of 10-year funds and does that make sense? I think there's much more of a market these days for secondaries. It seems like everybody and their brother has a secondary fund now. Right. And so it does feel like there's kind of, the market is almost developing an opportunity for people to invest in the strategies that they want to. So you might decide as an LP, you want to come into the incubation stage, which would be more of the VC arena. And then for other people who say, actually, I want these potential high growth tech companies, but I want them when they're much more stable and they've got big market share and we can, value them based on traditional metrics, et cetera. And that would be more like the secondary fund. And so you might be able to move. And if you were an investor who just wanted to hold even longer, you could potentially move with the funds. So I think listing is an interesting way to allow for that kind of timing flexibility, but the secondary market is also becoming an interesting place.
It is, and I was directly involved with secondaries as the Founders Club Equity Exchange Fund went smack into secondaries. So I was even supervised doing those deals. But I think that we've seen LPs and VCs respond to the imperfection of the 10-year to 12-year term 2 and 20 model, but it's not as perfect as being listed. Like NEA, for example, New Enterprise Associates, Dick Kramlich raised a huge fund to buy out his other funds. So you could be an LP in an NEA fund that's like $1 billion fund, and they're saying, look, Amazon is now public, or we don't want to sell, or this company is staying private forever, like Palantir, with a $70 billion valuation or whatever. And so he said the same LPs can invest in this fund and buy from yourself to this one. And you get like a right of first refusal to be an LP in the fund that's buying you out. So you get your exit. It sticks to the 10-year term with 2-year extension. And we don't have to get into some nonsense of LP consent that drags everybody into being in a 18-year, vehicle. But to me, it's never the same as publicly traded. I think if you just look at our funds of what the fair market value was when we invested and what the fair market value is 2 years later, these
Yep.
assets go up so much that
Yep.
if some individual like VCT EIX tax scheme person is investing in the next Beringea fund with 100,000 sterling, like 100,000 pounds, and then 2 years later, the fair market value is 400,000. It's listed on AIM. It might make sense for them to sell 100K depending on the lockups and the tax. And now they've
Yep.
got a zero cost investment worth 300K minus a
Yep.
bit for tax. So,
Yep.
and to increase the demand for the finite supply of what is
Yep.
ultimately these underlying startup high growth assets, that's better than being in a secondary situation with Dick Kramlich from NEA and some endowment that's a far from perfect market. Um, almost even you could argue bad for either the LP investing or the GP, depending on the
Yep.
lack of information. When you buy a used car, the seller knows if it's been in a car crash, the buyer doesn't. If
Yeah,
it's
and I mean, I think you're right about that. And I think some of the considerations, I guess, would be, so you could replicate that zero cost investment in a secondary by just cashing out part of your shares and then rolling part of it into the secondary. I think the idea that you'd be kind of passengers in a fund where the people who are making decisions are very large institutions and you're just a passenger, that's a challenge. Although, I mean, the downside to being invested in a listed entity is that you're not going to have the same levels of rights, consents, controls, information that you might if you were actually in a fund directly investing in investments.
sure. I've thought about, you just say to your, investor shareholders in your public listed fund, we're not going to divulge any information that would give us any handicap of going head to
Yep.
head with the, closed
Yep. That could
GPLP
make
guys.
sense.
So if
Yep.
you want high performance, we've got to drive this like a Ferrari, and not
Yep.
disclose anything other
Yep.
than, here's our methodology on marking to actually completed financings, and
Yep.
here's your TVPI, DPI, IRR, blah, 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 blah. But okay, well, sorry for getting so distracted, but I do think it's interesting. I
Yeah.
think one day we'll see more of this for very good reasons. But tell
Yep.
me about the so geographies. You said pan Europe, but if you're VCT, wouldn't that be mainly UK, if not all UK? So it's
No, VCTs are allowed to invest in non-UK based businesses, but there does have to be some kind of a UK angle. So we wouldn't be
okay.
investing in a company that was never going to be moving to the UK or never had a presence here. But
Okay.
I mean, in reality, most European countries look at Europe as the market and include the UK rather than specifically only ever wanting to be in Germany or only ever wanting to be in France. So most companies that we look at that are non-UK are still qualifying for VCT purposes.
Okay. And so I think your initial check size is typically 5 to 10 million, but if memory serves, but what's walk me through stage, geography, sectors.
Yeah, sure. So we generally invest in and around Series A, which for us, it means the company has to have commercial traction. So we don't do pre-revenue. Most of the companies we invest in probably have, and I'm going to talk in dollars because we generally do just because of the US UK angle, generally have somewhere between $3 and $15 million in revenue at the time that we invest. They don't have to. We invest in stuff that has sub $1 million, but we usually want to look for a run rate that looks something like $1 million. Sometimes we budget if we really love a deal. So in and around Series A, our history and our kind of expertise and bread and butter has been based on more early stage growth capital than binary venture. And I'll explain what I mean by that. So we tend to invest in companies that we believe can get to self-sustaining off the back of our syndicate of investors, rather than having to be reliant on somebody else's check to keep the company alive. That doesn't mean they don't go on to raise large amounts of money after that. It doesn't mean they're not loss making. It just means that we tend to shy away from things where the burn has to be so high that we can never control it to get to break even. We constantly need to feed the machine with new money. So we might miss out on, like, Spotify was a company that we didn't invest in part because it just didn't fit that investment thesis. The flip side is we have a very, very low rate of writing off businesses. So whereas the traditional venture model, 2 wild successes pay for 10 failures, we have a model where almost everything returns. I think our average writing off rate is something like sub 1 company a year. So we don't write things off very often. It's a question of, is this business going to return kind of our investment in change, or is it going to get us the 5 to 10x we were really looking for on investment?
And
Because of that
investment pace, if you're losing one a year, what's the investment pace of how many new investments, not considering follow-ons?
Yeah, we probably have 5 to 8 new investments in any given year. And I mean, by sub 1, I'd have to do the numbers, but I think maybe once every couple of years we write an investment off.
Yeah. Okay.
So we're not writing off 1 every year. We're probably writing off somewhat substantially less than 1. That is changing a bit, in part just because the market is changing. So I mean, it has been a great investment strategy. So we don't need unicorns, because you only need return the fund in unicorns if you are writing off a whole lot of the other investments, because you're taking really high risk positions. Because we have traditionally made great returns selling companies for somewhere between 50 and 500 million. We also have unicorns in the portfolio, and that's great. We've made phenomenal returns on them, but we don't need them to be unicorns. So we can invest in things that we believe are only ever going to get to 100 million in revenue in our watch, and that we're going to sell for 3 to 500 million. That's been a great model, but it becomes harder and harder to hold on to as the industry itself becomes much more entrepreneurial as a career. Because, like, if we think back to when you and I first met 14 years ago, certainly in Europe, very few people went to university thinking, I want to be an entrepreneur as a career. Like, it generally happened more organically. Somebody was in an industry, they were there for a while, somewhere between a couple years and 20 years. They saw something that wasn't working in that industry, and they decided to try and fix it, either out of necessity or because they just wanted to. And so they had some relatively deep expertise in what they were looking at. They generally brought a couple people they knew with them. They started it on their own and got a couple of customers and some traction, and then they went out to raise money. And they might have raised some friends and fools money along the way. Nowadays, more entrepreneurs than not that we see are people who knew they wanted to be an entrepreneur from the time they were at uni or shortly after uni. And they basically decided that was the career path and then found something to create, which is kind of the reverse of seeing a problem to go fix. You decide you're going to find a problem to fix.
People used
and the
to
ambition.
Go ahead. I was just going to say, people used to say that Americans, regardless of how much money you give them on an exit, don't want to spend more than a week of vacation with their family. They just want to work like crazy all the time. Whereas give a guy from Holland a £5 million euro exit check, and he's going to want to be in the south of France. I think that changed. I think that maybe for worse, Europeans are now as workaholic, aggressive as Americans. So they really get right back in. You see them cross over to VC quite frequently as well. So it's changing.
And very few entrepreneurs come to us nowadays. And the vast majority of them these days are probably under the age of 31, 32 founders. And they might surround themselves with more experienced people. And that's not, I don't mean that in a derogatory way, because a lot of them are so talented and wise beyond their years and way more fundable than I ever would have been at that age. So they're really impressive individuals, but they are a lot younger. And potentially it's related to age, or maybe it's just a cultural thing, but they're way, way more ambitious. So if you talk to somebody about, build this business that we could sell for 50 million in a couple of years, it's like, well, why bother? Whereas that wouldn't have been true historically. If you thought about a venture investment where somebody invested 5 million and it wasn't called Series A, it was just an investment. Like 14 years ago, nobody was talking about seed, Series A, Series B, Series C, and there was just no objective that you get to a Series B or a Series C. The objective was that you get to a great company, and you might need to raise along the way. And if you did, you figured out how much money you needed and you raised it. But if you, raised 5 million and got to a company and, you raised it at 2 or 3x at the time. So you gave away 30% of the company for 5 million, sold it for 50 million. The founders still took away 60, 70% of that company at the time. And that's a pretty good outcome. And there would usually be 2 or 3 people. The structures are way different now. And if you're going to raise 100 million, you need to do it at crazy high valuations. Otherwise, you're giving away a whole lot of the company. And then you need to sell it for crazy high returns because otherwise nobody's making any money. So the ecosystem has changed quite a lot. The ambition has changed quite a lot. With it, our investment strategy, well, we still stick a lot to the knitting of the idea that raising the next round of funding should never be the goal of the business. The goal of the business should be to build a great, amazing business that you want to own in 5, 10, 20 years, because then there will always be an exit market. And by the way, when I talk about business, for me, anything that's losing money is not a business, it's a cash black hole. If you're losing money, that might be fine, but the objective has to be at what point do we start making money? Because that's what a real business is. Before that, you're basically laying the foundations of a business. So the goal for us is generally, can we see the path to profitability, like genuine profitability? It may or may not happen during our watch, but can we see that path? And if we had to get there, if we had to get to break even, could you do it? Let's say the market zeitgeist changes, and for whatever reason, I mean, this basically happened in ad tech, where ad tech was the darling of the industry back in kind of the late 2000, well, I guess 2008, 9, 10, 11, 12, people loved ad tech. And then all of a sudden the zeitgeist went in the other direction and nobody wanted to fund ad tech.
Right.
So even if you built a great business that had,
I think those companies were the opposite of a clear path to profitability. They had this growth that, like, overnight, the growth was like, wow. And investors were saying, I'll take some of that growth. And it was hard to raise money for some ad tech companies because every VC had placed a competitive bet already. So it was like, they don't want to back two competing companies. But then it became clear that it was kind of like the old days of telecom. It was a race to zero of, what is it? Price times quantity equals revenue. If price is so competitively fragile, flat that anyone will churn to anybody else, then the total revenue, even though quantity is growing, price is under pressure. It's not a profitable business, despite that mirage of growth that they saw in the beginning. That's funny. So you guys are pretty broad of doing enterprise and consumer, if I remember. But what sectors are you most passionate about right now? Is COVID influencing you guys at all? What are your core investments?
Of course it is. Consumer remains really strong for us, not least because, we have great experience in the sector, so we can bring some genuine expertise and help with commercial relationships and expanding overseas. So we do have genuine deep expertise there, but it tends to be a place where we get great deal flow because, as you know, you do 1 or 2 deals and get a great return there, and then all of a sudden, you're the expert in the room and you get tons of deal flow in that space.
Right.
So we do get a lot to choose from. Similarly true with kind of SaaS and enterprise software in Europe specifically. Our U.S. office has a very strong bent on healthcare. We've had, dare I say, 1 unicorn this year and 1 more shortly to come. So we've done really well out of healthcare in the U.S. and it continues to be a sweet spot. So those areas of consumer SaaS and healthcare continue to be real sweet spots. I mean, for me, some of the stuff that I'm actually really interested in and passionate about are stuff that we're probably not going to invest in the near future, but might impact the way we think about investing.
Okay.
I'm kind of super interested in just basically the whole concept of space.
Yep.
Space travel, populating other planets, whether we do or not.
Mark Bogut, right?
Supermassive black hole that we just found out is so much bigger than we realized it was. So I think for me, it's just an area that I'm incredibly interested in from a personal perspective. We're not going to be investing in SpaceX or likely many other things, but like in the US, we have invested in a software company that helps monitor satellites. And I think that's the kind of thing that we would potentially continue to look at doing. Climate change is massively top of mind for us. I mean, ESG generally is massively top of mind, and it's way, way overdue. But with regards to ESG, there are things we invest in specifically as commercial investments that are ESG purpose driven. So for example, we have a company in the portfolio called Social Value Portal, which developed this framework called TOMS, Themes, Outcomes, Measurements. They developed it in conjunction with the UK government through local authorities to create a standardized framework for large companies during bidding process and tender processes to benchmark and demonstrate the social value that they create, so that becomes part of the criteria for tender and a bid process. It's a commercial investment for us entirely, and the company's doing phenomenally well. And they charge for software to use the benchmarks and then consulting fees to help people progress through the TOMS framework. We're actually adopting that for the VC industry at the moment with the help and support of about 25 UK and European VCs. So we've adopted the TOMS from a framework that's really meant for large corporates with dedicated resources into ESG and benchmarking. And we've modified it to be much more founder friendly, much more implementable and digestible. And we're kicking off a pilot project with about 10 recently funded, well-known UK companies on Friday. So for us, it's a significant initiative, both in terms of how we look at investing. So there's commercial opportunity. There's also opportunities to evaluate how the businesses we invest in are doing on that front and then help them do better. So we aren't making decisions based on, how good is your diversity and inclusion standard, or, what does your carbon footprint look like? But we are making investment decisions indirectly on, do you embrace this? Would you like us to help? How can we kind of progress together in making sure that we're better corporate citizens? So those are probably a couple of themes.
Do you must know Mark Bogut from Seraphim Capital?
Yes.
I think his current fund is 100% space related. And
yes, they have a really cool portfolio. Yeah.
And there's accelerators here in the Valley that are 100% space focused, where I think it was maybe 6 or 7 years ago, there seemed to be a movement or renaissance of like, oh, hardware is no longer hard, and hardware has got a renaissance of cheap and 3D printing, immediate feedbacks, and it's not like punishing sink the ship of a company for a little mistake on hardware, but that there's a whole category of startups that are doing things in space where they're like technically above the atmosphere, but it's cheap.
Yes.
The capital requirements are cheap. It's the opposite of SpaceX, which is cult of personality, just to shove the money in until you can get it right.
Well, I feel like a little bit of a poor cliche, because it does feel like if you're in venture or startup or entrepreneurialism, once you've been around the block a little bit and feel like you've seen everything, it's kind of port of call to then start looking outside the earth and start looking into the bigger universe. Except I just never made the same amount of money that any of the other Jeff Bezoses or Elon Musk's did.
Right.
So I feel like a little bit of a cheaper cliche.
Yeah, I think it's important not to confuse oneself of being, Mark Andreessen or, one of these guys, and I can do the same playbook that they do.
Yeah.
But I think there is a playbook for, relatively capital efficient companies that are doing things in that sector. I mean, I think Mark would be the guy to sit and let him lecture you for an hour, and he could give you the landscape. Well, so, 2020 was in the US a year of social injustice that spread all over Europe with the protests on what was happening here. Every now and then I go to Riyadh or Istanbul or somewhere where I'm pitching, where I'm like supposedly a judge for these startups, and I'm always blown away that it seems like 50% of the CEOs pitching in the Muslim world are women, and yet in the United States, even on, I was happy to have you on the podcast, partly to have a woman on the podcast. It's like a lot of the people I know are men. This industry is insanely, on the investment committee IC level or GP level of funds, it's a lot of men. And on the entrepreneur-backed, women-led side, I think the numbers are women-led venture-backed companies tend to have a higher success rate, but the total percentage is still not there. What are your thoughts on where we're at now and where we should be, or any thoughts on that?
Wow, so many thoughts. And I'm going to have to investigate why the rate of entrepreneurship amongst women in the Middle East is so much higher. That's a really interesting and good observation.
Well, I think,
do you know why it is?
Well, I have my own theories, and I should be careful what I say in such a public domain, but I think that it's kind of like Jewish people and going from Russia into Europe. We're just not going to get a job at the big, government or whatever big corporate of the day because of their last name and their heritage. And so they were forced to start their own thing. And so you see all these Jewish entrepreneurs going back to the millennia or whatever, that grandpa, great grandpa, grandma, they're all just entrepreneurial in nature and being willing to migrate and move. That
Yep.
that explains a little something there.
Yep.
And if they're all against us, then we can even band together to support each other. So there's a lot of stuff
Yep.
there on the Jewish side. On the women in the Middle East, I think if you are not being included in the government jobs, your dad, the patriarch, is not appointing you as the successor to run that business, and yet you have a lot of money. You've been shopping on the internet. You're seeing unique problems that exist there, and you start solving those problems. And maybe you do have access to some money yourself. Um, so
Yep.
I think that the failure to include in some way
Yep.
was like the same as if people are going to be anti-Semitically not hiring people based on their last name in Paris, that's going to
Yep.
force them to feed the baby some other way. And
Yep.
there may be a lot more to it. There's maybe some high education in there too. Um,
Yep.
they're highly educated in the wealthy demographics. Um, and then and then it gets a rolling success begets success. Your friend is doing a startup. She got funded. Now NEA is in the deal. Well, maybe I
Yep.
should do that too.
Yeah, 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 yeah. I am reminded. Yeah, it's a good observation. The I mean, from my own perspective, yeah. I mean, you already basically qualified everything. There's too few women in senior roles in VC, and way too few backed founders. And I think a couple of your observations certainly resonate with us. The female founders we do see tend to have businesses that are more profitable, often tend to have better outcomes. Our third best investment ever was two sisters, Monica Venator, who founded a jewelry business. And given the number of women that we have invested in, I would say the hit rate for women is way higher than the hit rate for men. Part of that, there's a lot of stuff that goes into it, but I think yeah, you hit the nail on the head, and that's largely been my experience. I would say the things that I haven't experienced as much as it seems other people in the industry have are a lot of the hardship situations. And I don't know why this is. I don't know what it is that, and maybe I'm just kind of an idiot and didn't see it, but I've heard all kinds of horror stories about how women have been treated in the industry and stuff that has been kind of unconscious demeaning, like talking about interviews and asking people when they're going to have kids and how are they going to manage that. Like, I generally never had a lot of that. I mean, there have been bits of it, but, and maybe it's natural selection where, if I'm feeling that way, I'm probably not interviewing very far for a job with them. But I've been treated really well throughout my career. I mean, I started my career in consulting. That was the first kind of 10-ish, maybe a bit more years. And I didn't
BCG,
really feel like,
right?
yeah, first a company called Kurt Salman Associates and then BCG. I also ran the watch division at Swiss Army, which, as you can imagine, Swiss Army is a pretty male-dominated industry and business. But it was a woman who bought the company out and brought me in as the head of the watch division. So like, it wasn't an area where you were going to start being particularly misogynistic. So I feel like I've just been very lucky and well supported throughout my career, which I hope that can then help and pass on to other women. So I feel awful about the people who have had these horror stories, and I just haven't really had the same experience. Plenty of things that just aren't really thought through, that are not really female friendly. So one example, we used to have season tickets to Arsenal, the British football team, a major team that everybody here will know, and we used it for corporate entertaining. We had 2 tickets, which meant that you could invite a guest and go. It's a little bit more awkward for a woman to say to, some other guy who's a banker, would you like to go with me to an Arsenal match this evening, and we'll go kind of have a bunch of drinks before and have a bunch of drinks after. So it's a little bit more awkward. Not terrible, but I tended to, if and when I used the tickets, which wasn't that often, I tended to invite people I really knew well, just because I found it awkward to invite people
This is
that
not
were
a
kind of.
date. This is not a date
Exactly.
with a lot of drinking. Yeah.
Exactly. And then the kind of the best culmination was, So there was like, I don't know, a random Thursday night. Nobody wanted the tickets, or I think it was even a Saturday night. Nobody wanted the tickets because it wasn't a great match. I said, yeah, fine, I'll take them. And I took a guy I knew in finance, but he happened to be a really good friend who I went to INSEAD with. So it was kind of corporate related, but it was really just nobody wants the tickets, so I'll take a friend. And I went inside partway through the match, and the guys in the seats next to us were also season ticket holders. So I'd gotten to know them over a while, and it was a father and son. They were both adults, but knew them vaguely on a first name basis. I went inside, and they were chatting with my friend who I brought. And after a couple minutes, they said to him, "Look, you seem like a really nice guy, so we thought we should tell you this woman is here every week with a different guy."
Oh.
And it's just that never would have happened to a guy, right? Like that never ever would have happened. And just other things, like there was one year we were having we had a portfolio company that was going through a really challenging time, and I was having difficult conversations with the CEO. And we said, look, let's go. And it was an amicable relationship, and everything was okay, and it turned out okay-ish. But we said, let's go to dinner and just talk about a bunch of this stuff. And so he made reservations somewhere near where he was, where their offices were, and I just met him there. And for whatever reason, both of us blanked on that it was Valentine's Day. This was before, this is like 15 years ago, before I was married, and for whatever reason, we both blanked on it. So we get to this restaurant, and of course, there's roses on the table. They're bringing over champagne. They're asking if he would like to order for me. They've got this romantic Valentine's Day menu, and it was an exaggerated version of it, but generally kind of going to dinner with a CEO where you might be happy to go and spend hours out and maybe even go to a bar and then drink a little bit more. Like that becomes an awkward situation if it's just me and somebody else. So it's more of those really just, the industry isn't necessarily set up for entertaining the way it might ideally be. But other than that, yeah, we just need more women in senior roles and to encourage more women to be looking for funding.
I think if you ask men, what do women want? We don't know. And so to have not include more women in this decision making of what products and service offerings that should be out there sounds like it's got some logic going for it. But it's definitely noticeable. And it's ironic that as a Westerner, you expect if the women are not allowed to drive cars, would they have a higher percentage of those running the companies? But indeed it is. So that's interesting. Well, listen, we should close up, but what's your sense of the exit market in where we are? I mean, Boris announced that, there's a path to opening things up in June and July. That's still a long time away. Do you feel like any of your portfolio companies are not exiting because of this current environment, or we saw a whole bunch of SPACs and a whole bunch of IPOs at the end of last year. So for the big ones, exits are possible, that's for sure. If it's an American company buying a European or UK company, they might want to go out for that drink and kick the tires and look you in the eyes. I don't know. What's your sense?
So the truth is, I don't know. Are there companies we would have sold if we weren't in the midst of COVID? But we're definitely seeing a lot more activity than I ever expected us to this year. And a lot of it is coming from US kind of mid-market private equity firms. Quite a few, I mean, some are the big notable names that and they're not mid-market, they're actually large private equity firms that have kind of growthy type funds. And we see a lot more private equity, especially in the US, bleeding into the growth cap space or even into the venture space. So we've had a number of unsolicited approaches for our European portfolio this year. The distance didn't seem to make a difference. They still underwent, really thorough due diligence. In some cases, the deals were closed. In some cases, they weren't. But they weren't necessarily companies we were looking to sell. There was a lot more inbound interest. So we're seeing quite a lot of it. I mean, interestingly, it does feel like there are some private equity players who have growth funds who have been doing it for a while and know what they're looking for and have a methodology and a playbook for finding it. There are others who just have too much money to spend. And so this is a new area for them. And it really feels a little bit awkward. Like it feels like they're not quite sure how to attack it, and the level of diligence that they're doing, and the large scale McKinsey, Bain, BCGs they're bringing in to do due diligence on a company with small tens of millions of revenue. It does feel like it's just kind of an awkward process, but I think they'll figure it out. So at the moment, and I mean, as you say, we're taking advantage of SPACs. We've got at least one in play right now, possibly two. I really am skeptical about the long-term SPAC market. It's just an indication that people have too much money and are trying to find places to put it. But right now, it feels buoyant. I think the place that is really difficult to be is if you're kind of an old behemoth, whether that's large high street businesses are suffering, whereas, agile online consumer businesses are doing phenomenally well. And I think that's where the exits are difficult.
Right. We've seen within our portfolio, a few were suffering badly from COVID, and most of them, after a few weeks of uncertainty, started surfing it up and
Exactly.
being like kind of your
Yeah.
Zoom winners. But well, that's great. Listen, Karen, it sounds like maybe by the summer we'll be meeting people in person again. The vaccine rates look quite good in the UK, so that is encouraging.
Yeah.
That they figured out how to get their hands on it and get it into the people. So that kind of gives me confidence, on things. And it seems like the UK has kind of found its place within Europe again after all this Brexit stuff. So I think that
it does. It feels more like a light thud than the huge bang we were all waiting for. But I guess the long-term impact of COVID. I mean, there are plenty that we could talk about separately, but I do worry about how are we going to do this every year. Like if COVID is just going to keep evolving and we have to keep vaccinating ourselves in a slightly different way, given the complication of year one, even if we get it 50% better, this feels like a challenge. And I just don't know how we're going to tackle this every year. And I'm hopeful that we're going to find out that we don't need to tackle it every year.
Yeah, I'm hopeful that the progress on decoding the genome sequence and all of that means that we can more precisely adapt to new strains and things like that. And it may be that we need to adapt our clinical trial FDA, side of the house to make these things more livable. But I don't know. I used to speak at a lot of events and I kind of miss a little stage time, and people are really investing in events that are going out in June, which they're saying will refund people. But October, even we're planning our LP portfolio, get everybody together events, committing to October that we think you can get on a plane from Tokyo to the Valley or anywhere, and that'll happen again. I think Americans have always done business over the phone, and I've always pushed for video. Like, is it worth my time to go to the East Bay to meet somebody? How about a video call first? Then we can meet in our office in San Francisco. But I think it's a positive thing that you can talk to more founders, you can talk to more LPs, you can talk to more VCs, and spend a lot less time in the airport lounge or, flights being delayed.
International expansion. And international expansion for our portfolio companies has absolutely accelerated. Because once you realize you don't need to be there, whether you're selling a software product or you're selling a physical good, you realize you don't need to be there either to hire or to distribute or to sell. All of a sudden, the ambition gets bigger faster.
Yeah, well, I think COVID is definitely moving the goalposts on people that say, I must meet you in person. I have object permanence disorder. If I don't see the doll, the doll's dead. And that's the way it is in a lot of the world that I've raised money in. So I'm really excited about getting stuff done over Zoom and then meeting in person when it absolutely has to happen or it's fun to happen. Well, listen, great to see you, Karen. Good luck with the success. And when we do meet, I'd love to even share ideas of how carry should be distributed in a permanent publicly traded vehicle. I've got my own ideas on what works for everybody there.
Great. I so appreciate it, Andrew.
Okay, thanks so much. See you soon. Bye for now.
Great to talk to you. Take care.